Hey everyone, welcome back to the channel. Today we're cutting through all the noise and talking about the best way to invest your money in 2025. With no hype, just results. This is for people who don't want overnight schemes, but long-term growth, peace of mind, and smart decisions. Let's break it down, step by step. Before you invest a single dollar, take care of this first. 1. Emergency fund. You need 3 to 6 months of living expenses in cash. Keep it in a high-yield savings account or money market fund. This protects you from having to pull out investments during a crisis. 2. High-interest debt. Pay off credit cards or any debt with interest over 6-7%. Why? Because there's no point earning 8% in the market while paying 20% in interest. 3. Budget. Know your numbers. Income, expenses, savings rate. If you can save at least 15-20% of your income, you're ready to invest. Investing without a goal is like driving without a map. Are you saving for retirement? That's long-term, 10, 20, or 30 years. Want to buy a house in 3 to 5 years? That's short-term. Building wealth or passive income? That's medium to long-term. The strategy you choose depends on how soon you need the money. Longer timeline equals more growth opportunities, but also more volatility. Step 3, use tax-advantaged accounts. Now we talk accounts, not investments yet. 1. 401k or 403b. If your job offers this and there's a match, invest at least enough to get that free match. It's free money. Don't leave it on the table. 2. Roth IRA or traditional IRA. These are for retirement. Roth is after-tax money that grows tax-free. Traditional gives you a tax break today, but you pay later. 3. HSA, Health Savings Account. If you're eligible, this is a triple tax-advantaged account. Great for healthcare expenses or even as a stealth retirement account. If you max these out and still want to invest more, go to a taxable brokerage account. No tax breaks, but fully flexible. Step 4. Keep it simple. Choose proven investing account. Now to the core. What should you invest in? In 2025, with all the tech hype, AI, crypto, and meme stocks floating around, the smart move is still simple. 1. Low-cost index funds or ETFs. S&P 500 index fund, like VOO or FXAIX, owns 500 of the largest U.S. companies. Historically returns about 10% per year over decades. Total Market Index, like VTI, owns almost the entire U.S. stock market. Total International, like VXUS, gives you exposure outside the U.S. 2. Target Date Funds. Perfect if you want a one-and-done option. These adjust risk over time and rebalance automatically based on your retirement year. 3. REITs, Real Estate Investment Trusts. If you want exposure to real estate but don't want to be a landlord, you can invest in REIT ETFs like VNQ. FXAIX fees eat returns. Step 5. Automate and stay consistent. 45 seconds. Set it and forget it. Here's how. Set up automatic investments every payday or every month. Don't try to time the market. It doesn't work. Even pros fail at it. Use dollar cost averaging, investing a fixed amount regularly no matter what the market is doing. It takes emotion out of the equation. Consistency beats intensity. Even $200 a month can grow to hundreds of thousands over 30 years. Step 6. Diversify, but don't overdo it. Diversification reduces risk, but too much can dilute returns. A solid portfolio could look like this. 60% U.S. stocks, S&P 500 or total market, 20% international stocks, 10% bonds or fixed income, 10% REITs or alternative assets. You don't need 30 mutual funds or 50 stocks. Stick to a few well-diversified ETFs or index funds. Step 7. Review once a year. Once a year, review your investments. Rebalance if needed. For example, if stocks went up a lot and now they're 80% of your portfolio. Adjust based on life changes, new job, marriage, kids, etc. But don't check daily. The market goes up and down. You win by staying in. Bonus. What to avoid? Let's end with a few don'ts. Don't chase hot stocks or TikTok trends. Don't invest in anything you don't understand. Don't panic sell during downturns. Markets recover, always have, and most importantly, don't wait. The best time to start was yesterday, the second best time is today. To recap, build a solid foundation, use tax-advantaged accounts, invest in simple diversified index funds, automate everything, and stay consistent. That's how you build wealth in 2025. No hype, just results. If you found this helpful, give it a like and drop a comment below with your questions or your favorite investing strategy. See you in the next video. And remember, slow and steady wins the race. Let me know if you want this adapted into a YouTube video script with visuals or bullet points for a slideshow.